Hi, everyone. My name is Bonnie Luttrell, and like Seth said, I work for the Student Borrower Protection Center. Before we dive in, I just want to mention that if for any reason you need to log off early, just know that this presentation is being recorded, and CFE will give you additional information about how to access that. In today's presentation, I'll start by giving an overview of the federal student loan protections included in the stimulus bill, including immediate steps you and your clients can take to manage their student loans if their job, finances, or family are impacted by the coronavirus pandemic. However, the protections do have an expiration date, and we want borrowers to be set up for long-term success. So the second half of the presentation, we'll walk through what borrowers can do long-term to stay on top of their student loans. One quick note before we dive in, also, please be cognizant of scams that market themselves as student loan forgiveness or debt relief. We're already seeing them pop up on social media, so please remind your clients that they should never, ever pay anyone to help them with their student loans. The presentation is broken down by type of student loan. Very broadly, there are two types of student loans, federal and private. Federal student loans are usually made by the Department of Education and have names like Direct Loans, Parent Plus, Stafford, etc. Private student loans are made by private companies like Discover, Wells Fargo, or PNC Bank. So keep that in mind as we walk through. Last Friday, Congress passed the CARES Act, which, among a variety of things, includes immediate relief for federal student loan borrowers. Before I walk through these, I want to clarify that the protections are limited to only certain types of federal student loans, specifically federal loans that are owned by the Department of Education. It does not cover commercial FFEL loans or Perkins loans, and we'll talk more about that in a minute. For the next 6 months, April through September, most student loan borrowers can expect to see some relief on their student loans. For starters, all interest has been waived through September. Second, all payments will be suspended, meaning borrowers won't have to make a payment until October. Additionally, even though borrowers won't be making payments, they will still get credit towards loan forgiveness programs like public service loan forgiveness or income-driven repayment forgiveness, provided that they meet all the other requirements. And then finally, for the most distressed borrowers, all collection activity will be halted. I've tried to condense the most important pieces of information here that borrowers should know. First, the interest rate waiver and payment suspension are automatic. In fact, borrowers should already be seeing the interest rate waiver on their accounts. The payment suspension is still being implemented. So the best thing borrowers can do right now to protect their bank accounts is turn off autopay. It takes 3 days to process autopay shutoffs, so do it as soon as possible because it's unclear if and how borrowers will be able to get back any auto-debited payments. Additionally, while the pause on Social Security and tax refund offsets will be automatic, the pause on wage garnishments is not automatic. Borrowers will need to affirmatively reach out to their HR department to make sure the employer stops the garnishment through September. There's a lot of information that the department has failed to provide guidance on, so these next two bullets are recommendations so borrowers can best position themselves regardless of what the department says. First, borrowers should continue to enroll in and recertify income-driven repayment plans. We'll get into that more thoroughly in a second, but borrowers should know that they don't need to make payments, but they should still keep their enrolled status. And as we'll discuss later, doing so will protect borrowers against a lot of potential negative repercussions like interest capitalization. Now, I want to take a minute to focus on this last bullet here. A week or so before the CARES Act passed, the Department of Education opened up the option for borrowers to enroll in emergency forbearance. However, right now, time spent in forbearance is not eligible for the qualified payment credits I previously mentioned. So borrowers should contact their servicer to get the forbearance lifted as soon as possible to take advantage of the full benefits offered under the payment suspension. The Department of Education may decide to override this and provide credit during the forbearance period, but it has not yet done so. So this is still going to be the best option for borrowers. So while the CARES Act did do a lot, there's still several unanswered questions. As of right now, we don't know what protections, if any, are being offered to borrowers with those other types of federal student loans. I also mentioned that some people have already had their auto payments processed. Guidance on refunds is unclear still. And borrowers who have negatively amortizing loans haven't yet been told whether their interest is going to capitalize at the end of the suspension, similar to the way a forbearance traditionally operates. And then finally, borrowers who were furloughed or laid off haven't been told whether the department will temporarily waive full-time employment requirements for PSLF. And so I flag these because as this information gets resolved, we'll be sure to update you, but just keep in mind that there's still some uncertainty. Now I want to dive into how borrowers can find out what type of loan they have. I mentioned that there are different types of federal student loans, and only some of them are eligible for the protections we discussed. Direct loans are the most common type of federal student loan. Perkins loans, which are loans taken out directly from college institutions, are not covered, and it gets a little trickier when you get into federal family education loan program loans. These are older federal loans that are backed by the Department of Education, but were made directly by banks. The department bought back a bunch of these several years ago, and so now some are owned by the department, some are still owned by private companies, and so it can be a little tricky to figure out what kind you have. If your FFEL loans are owned by the Department of Education, you're covered under all of the CARES Act protections. If they're owned by a private company, they are not covered in the CARES Act. The easiest way to figure out what type of loan you have is to call your servicer, but obviously that doesn't do any good if call centers are closed or understaffed and it takes you hours to get a hold of somebody. So here's how a borrower can find out if they can't get a hold of their servicer by phone. I'll spare you walking through the steps I have laid out here. You all can see those, but we'll send a handout to Fernanda to share with all of you that includes this information as well. Basically, you want borrowers to pull their data files from the Department of Education's website. The data comes up as a text file, so once you open that up, there are a few key indicators of what type of loan the borrower has. Keep in mind they might have several different types. Under loan type, you'll see names like Direct, Bell, Perkins. That's the first step to narrowing it down. Then you want to look at the two lines that are both, unfortunately, confusingly named loan contact type. The first one is the servicer. If you have an eligible loan, that will say current ed servicer. Both direct loans and ed-held FFEL loans will have current ed servicer listed right there under number 2. The other loan contact line lists the lender, which should say Department of Education. For commercial FFEL borrowers, this information will look a little bit different. It will still say FFEL up top, but the lines 2 and 3 will reflect the private entities. One loan contact will be a guarantee agency, but you really want to focus on that second loan contact line, number 3 there, which lists the private lender. In this example, you'll see where the previous one said Department of Education, this says US Bank. And so we know that this borrower has a commercial FFEL loan. So the CARES Act did a lot of great things, but it's limited in scope and temporary. So the rest of this presentation is going to focus on protections that are eligible to borrowers at all times. And this is going to focus on how you can set borrowers up for the long-term repayment success I mentioned at the beginning. Federal student loans offer a variety of repayment options, but very broadly speaking, there are 4 types of plans: standard, extended, graduated, and income-driven. The first repayment plan is called standard. This is the repayment plan that you start in as soon as you leave school and exit your grace period. For most borrowers, a standard repayment plan requires that you pay the same amount every month for 10 years, at which point your loans are paid off. If you have a consolidation loan with a high balance, this period might be extended out over 15, 20, or 25 years. If your payment under the standard plan is unaffordable, you can choose from any of these other repayment options. Extended repayment offers you a payment lower than your standard plan, but over a longer period of time. You will end up paying more interest on your loans long term, but it provides you immediate relief from your monthly payment burden. Graduated repayment works kind of like a staircase. You start off paying small amounts, and then every 2 years, your payment amount increases. During the second half of your repayment term, your payments will generally be higher than they would have been under the standard plan. And finally, the plan we're going to focus on today is income-driven repayment. Income-driven repayment plans, also called IDR plans, are unlike any other repayment plan in that they peg your monthly payment to your income, not your loan balance. As a result, you should never have to pay more than 10 to 15% of your discretionary income. And if you stay enrolled in an IDR plan for 20 or 25 years, depending on the specific IDR plan you're in, you can have the remaining balance of your federal student loans forgiven. This is entirely separate from PSLF. This is a forgiveness option available to everyone, regardless of employment. There are 4 types of IDR plans available based on what type of loan you have and when you took it out. These are called income contingent repayment, or ICR, income-based repayment, or IBR, pay-as-you-earn, pay, or revised pay-as-you-earn, repay. Don't worry if this seems like a lot of information. You don't actually have to know the difference between any of these plans, and I'll explain more on that in a minute. One of the best features about income-driven repayment plans are that if you are unemployed or have low income, your payments can actually be $0 per month. I know there's a lot of technical information on this slide, but the one takeaway is that Corona protections aside, if you are struggling or expect to be struggling come October when the payment suspension is lifted, this is the best option to get your payments immediately recalculated into an affordable amount. If you want to estimate what your monthly payment would be under one of the IDR plans, or if you want to work with a client to figure that out for them, you can use the formula posted here. In short, your payment is 10 to 15% of your discretionary income, like I said, which is calculated based on a portion of your adjusted gross income. If you don't want to do the math yourself, you can also use the Department of Education's repayment estimator, which lets you plug in numbers to do the math for you across all of these repayment plans. And again, we'll make all these links available for you after. So here are some of the great things about IDR. Many of the plans offer certain subsidies on your loans, meaning the Department of Education will pick up the difference on any interest not covered by your payment. Additionally, if you are delinquent but not yet in default on your student loan, enrolling in IDR will automatically bring you current without you having to go back and make up your missed payments. And finally, one of the most significant benefits is that, and that's what we'll focus on next, is that if you experience a change in income, like you or your partner losing a job, you can have your payment immediately recalculated to factor in this change. So before we dive in on how to enroll in one of these plans, I want to stress that even though payments are being suspended, borrowers can and should still enroll in an IDR plan to lock in the low payment so that come October, they don't face payment shock. There are 2 options for enrolling in an IDR plan. You can submit an electronic application online, or you can submit a paper application to your servicer directly. Regardless of your situation, you can start the application online. However, if your last tax filing is not reflective of your current income, for example, if you were recently laid off, then you will be instructed to finish the application outside of the online tool. We'll talk about that more in a second. But I mentioned previously you didn't have to know all the nuances between the different types of IDR plans. That's because the IDR application includes an option to have your student loan servicer place you in whatever plan offers you the lowest monthly payment amount. For most borrowers, that's going to be pay-as-you-earn or revised pay-as-you-earn. And then one flag for Parent Plus borrowers, the only IDR plan that you're eligible for is income contingent repayment. To enroll in an IDR plan online, the first step is to go to studentaid.gov and log into the federal student aid interface. You just navigate over to manage loans and apply for an income-driven repayment plan, and it'll guide you through the rest of the way. Keep in mind that there will be different options for enrolling in an IDR plan for the first time or recertifying your income for an existing plan. At that point, you can navigate through the enrollment wizard until you get to questions about income. If you want to use last year's tax information to enroll, you can actually connect directly to the IRS website and import your income information all directly within the tool. I want to highlight a couple of pieces of information for married borrowers here. Under all of the IDR plans, If you file your taxes jointly, your spouse's income will be considered when calculating your monthly payment. There are also options if you're separated or otherwise don't have access to your spouse's income information, but just flagging that will affect your monthly payment amount. If you file separately, your spouse's income will only be considered if you enroll in revised pay-as-you-earn. Income-based repayment and pay-as-you-earn would not count your spouse's income there. And if your spouse has federal student loan debt as well, that debt will also be taken into consideration while calculating the monthly payment. So finally, after you complete the information and hit submit, the information gets automatically routed to your servicer, and within a few weeks, you should be notified of your new IDR payment amount. Now, if for any reason your last tax return was not representative of your current income, like job loss, cut hours, anything at all, I recommend starting with the paper application. Rather than navigating through the wizard and having it kick you out to print it, I think you should just start with the paper application. Most servicers let you scan and upload the application onto their website along with proof of income, but you also have the option to mail it in. The first step is to complete the application and attach proof of current income. Proof of income should be no more than 90 days old, and you could attach a recent pay stub or a letter from your employer stating how much you earn and how often. So for example, if you're using a pay stub, write on it paid every week or every other week. And if you were recently laid off or had your hours completely cut or you have no income, you can also do what's called self-attestation of no income. So to do that, all you need to do is check the box that says you have no taxable income. No additional documentation is needed. Now I want to take a minute to address some suggestions in case you're facing a sudden income shock or your client is facing a sudden income shock. And this is particularly relevant for borrowers with commercial FFEL loans who are not covered in the CARES Act. So there are still things they can do. So starters, again, if you're enrolled in autopay, keep in mind that it takes at least 3 days to suspend that, and it's very difficult to get the payment back once it's already been withdrawn. So if your payment is due at the end of the month and you're going and you think you might be getting laid off, consider stopping autopay now. Second, if you have a direct loan or an Ed-held FFEL loan and we're at least 31 days delinquent, you may have already been placed in forbearance. Forbearance was applied automatically to borrowers with these loans as part of the Department of Education's initial response to the pandemic. This is important to know because the IDR application will ask you whether you are currently in a forbearance, and we've seen borrowers have their applications rejected just for answering this one question incorrectly. And third, if for any reason you can't get the payment situation on your federal student loans sorted before your next payment is due, just remember that there is no immediate derogatory credit reporting on federal student loans. Even without the CARES Act, there's a 90-day window before the loans are reported as delinquent. And finally, just to reiterate what I flagged earlier, borrowers who have loans covered by the CARES Act and or in garnishment should reach out to their HR departments as soon as possible to start the process to get the garnishment paused. We expect this will take some time to process, so don't wait. Now, let's shift to what to do if your federal student loans are in default. The good news is that in the short term, a lot of the scary things that come with defaulted federal student loans have been paused. However, these collection efforts will all kick back in October 1st. So if the borrower doesn't cure the default, they're going to be subject to this whole list here. Wages will continue to be garnished without a court order. Social Security benefits will be offset. Tax refunds can be withheld. I've been recommending to all borrowers in default to take advantage of the payment suspension period to use that time to explore the most appropriate default cure option for them. So there are two main ways to get out of default on federal student loans besides paying off all the debt. The first option is consolidation. Simply put, consolidation bunches up all of your defaulted loans, pays them off with a new loan at the same interest rate, and you start over. To be eligible to consolidate, you have to have at least one eligible loan, and we'll talk more about what that means in a minute. You also have to agree to enroll in an IDR plan at the time of the consolidation application. Usually you cannot immediately consolidate your defaulted loan if your wages are currently being garnished, but the Department of Education hasn't yet clarified how this will work. in light of the pause on garnishments. But as soon as it does, we'll of course send that information around. The second option is rehabilitation. A rehabilitation plan lets you make 9 payments to your debt collector, and after you successfully make those payments on time and in full, your loan exits default and is transferred back to normal servicing. Rehabilitation is a little more complicated than consolidation, and I'll explain why, but generally my recommendation to borrowers is to pursue consolidation. The great thing about consolidation is that as long as you are not actively being garnished, you can complete the process entirely online. You log on the same way you would if you were enrolling in an IDR plan. You can complete the whole application in one sitting, the consolidation piece and the IDR enrollment piece. So it's a great option right now when call centers are not open. A couple of things to keep in mind, while consolidation does remove your loans from default, it will not change the existing credit reporting. So you'll still have a defaulted loan on your credit history, but the consolidation will end and you'll start a new credit line there. Sorry, one more thing to add. Traditionally, the entire consolidation process from application to getting your first bill takes about a month. However, we don't yet know if there's going to be a disruption in the consolidation processing given the staffing upheaval happening right now. So I recommend everyone getting their application in as soon as possible if this is what you want to pursue, so you can be sure by the time that the payment suspension is over, you're all set with your new loan. So the other option available to defaulted student loan borrowers is rehabilitation. One thing I want to flag up top, rehabilitation requires a lot of communication with your debt collector. And as more and more call centers are getting shut down, it's important to know that this may be a really difficult option to pursue right now. As I previously mentioned, in a rehabilitation plan, you make 9 monthly payments. Those payments can actually be adjusted depending on your income and expenses, but must be at least $5. Under normal circumstances, if your wages are currently being garnished, the garnishment can be factored into the payment amount, and after 5 on-time payments, the garnishment will actually be lifted. We don't yet know enough about how this works with the CARES Act payment suspension, but again, definitely we'll let you know as soon as we know. Completing a rehabilitation will also remove the default from your credit history. It won't remove the months of delinquency that preceded the default, but you'll no longer have the default itself noted on your credit. A lot of borrowers really like the idea of having the default removed from their credit, but I caution borrowers about their expectations on the actual impact this will have on their credit. A study from the GAO found that rehabilitation for private student loans only gave an 8-point bump to credit scores. And so I asked borrowers, like, given the extra burden of managing the 9 payments and making sure you're getting accurate information from the collector, are you better off doing that for that small bump, or do you want to pursue the consolidation? Again, the reason why I recommend consolidation over rehabilitation is that consolidation can be completed at once, including enrollment in the IDR plan. There's less room for error, particularly at the point of handoff between your collector and your servicer. And so if you're trying to rehabilitate your loan and the collector miscalculates your payment, which actually happens quite often, like none of the payments you made will have counted towards your required 9. In short, there's a lot of ways rehabilitation can go wrong, and consolidation, it's much easier to get right. And so for borrowers who are in precarious positions and just want to shore up their finances, I generally think that's the best approach to take. So here are some other things to keep in mind. If you have re-defaulted, meaning you were in default once, got out, and then defaulted again, note that your options may be more limited. For example, if you rehabilitated your federal loan but defaulted again, you can't rehabilitate again. Second, if you have already consolidated a federal student loan, you may not be eligible to consolidate out of default. You need at least one eligible loan to consolidate. And finally, here's some long-term information you can have in a post-CARES Act world. If your wages are being garnished and these options to remove the garnishment aren't available to you, you can request the garnishment be lifted for 12 months through an administrative hearing. I tell borrowers not to let the word hearing scare them. You can do the whole thing over the phone and computer. You just log on to the website listed there. access the hearing request form, select the reason why you're challenging the garnishment, and then say you want to conduct the hearing over the phone. Now I want to shift to private student loans. While private student loan borrowers don't have any of the guaranteed rights that federal student loan borrowers have during times of financial distress, there are still things you can do. Many private student lenders offer alternative repayment plans. You just have to be persistent. So again, it may be difficult to get these plans locked in because the call center is getting closed. So try to get in touch with your student loan servicer through any other means: email, online portals, social media DMs. Private lenders may also offer temporary deferments on payments, interest rate reductions, or other options. Some lenders, like Discover, publish these options on their website. Others are more reluctant to offer them. So again, be persistent. Ask to talk to a supervisor if you need to. If you're denied, ask why. One important thing to keep in mind on private student loans is that things are changing every day. More and more lenders are committing to waiving late fees, waiving interest, and we also expect more lenders to offer temporary payment or relief amid all the financial chaos. So the best advice I can give here is for borrowers to check in early and often and be very upfront with their lender about any financial difficulties. And believe it or not, there are still some courts open and collectors are still seeking judgments on defaulted private student loans. Other courts have closed for anything except emergency filings, so the information here is very situation specific, but certainly relevant once things return closer to normal. So here are some recommendations to work with private student loan collectors to ensure it doesn't escalate amid all that's going on. And these recommendations are very similar to what you would do with any other sort of consumer debt. Negotiate with your collector. If the first person isn't receptive, try again. Figure out what you can afford to pay, if anything, and offer that. Always get the settlement or modified payment amount in writing. Confirm how it would be reported to your credit. And finally, remember that private student loans are subject to a statute of limitations. So that means after a certain amount of time, as long as you haven't reinitiated payment, the collector can't pursue you in court for payment. So several of the options I talked about today require you to get in touch with your servicer or your collector. However, that's not really helpful if the call centers are closed or if they're wildly understaffed. So here are some alternatives if you can't get through by phone. Emails and social media accounts are still being monitored. And from what we've seen, many of the servicers are actually being most responsive when borrowers call them out publicly. So I tell all borrowers I work with that if they can't get through, don't be shy about contacting these companies through Twitter, Facebook, Instagram, and of course, email. We've seen numerous examples now where this approach ensures the borrower's account actually gets handled by an escalated case member or case team member.